Well, hi. In this video I want to talk about some objections that I've heard for reverse mortgages. Why people don't want them and the objections that they have. Okay, so the first one is that it will chew up all my equity. Well, no, it won't. It won't chew up all your equity because they're never going to give you 100% of the value of your property anyway. Okay, they're only going to give you maybe 50% or 60% or something like that, 70% at the outside, depending. But let's say you got a $500,000 house and you have $250,000 reverse mortgage loan on it for whatever reason. You know, you owe 100 and you got 150 in cash out or whatever. It will never be chewed up completely. And the reason is this: if they charge you 4% per annum on it, and they're going to also they're charging that on the loan amount, not on the total value of the property. Okay. So if they're charging you 4%, it's only on the $250,000, not on the whole $500,000. So you can repatriate the charge within 6 months. So they're only taking away 6 months worth of equity, not the entire amount. Okay, and you can see this in my other video, and I urge you to watch it. It's called the scenario 3-page scenario video, the reverse mortgage 3-page scenario video, where I actually build an actual scenario from scratch and I show you exactly the 3 pages that you'll get in a PDF document from me for free when you just give me a little bit of information about you. Where do I send the PDF and the property? Okay, so just do that and you can see how the numbers work in there because I show you the amortization schedule and everything else. So you can see that it does not chew up the entire equity of the property. Okay, all right, next, I will lose my tax deduction for the interest. So what? You're not making any mortgage payments, so I think losing the interest deduction on your taxes is not really all that bad a thing when you don't have to make any mortgage payments at all. Okay, next, the upfront fees are too high. Okay, yeah, the upfront fees are high, but a couple of things. Okay, the first part of the upfront fees are too high. If you didn't have the upfront mortgage insurance, you wouldn't have any program at all. There would be nothing for you. Okay, and there wouldn't be, without mortgage insurance, there wouldn't be people getting into properties at 3.5% down either. Okay, so you have that mortgage insurance there to handle the eventualities of defaults. And remember, 3.5% down to reverse mortgages, these are the most defaulted loans in the market today. So you have that insurance for that. Now let's talk about that money. Okay, that money is not money out of your pocket. You didn't go out and earn it and put it in your checking account and then pull it out of your checking account and then spend it into your reverse mortgage. That's not how it works. It's just tacked on to the mortgage loan amount, okay, which means it just is deducted from your equity in the property. Well, here's my thought on that. If you were not paying on a mortgage, wouldn't you have to be renting somewhere? Well, of course you would. You'd have to be renting. If you're renting, what are you paying for? Shelter. That's what you're paying for, shelter. In a mortgage, when you're paying on a mortgage, you are paying for shelter, because if you didn't have that mortgage, you'd be paying rent someplace, so you are paying for shelter mainly. Okay, so let's just say mainly on that. But you're paying for shelter. So the equity buildup that you have over time is really what? It's dollars you didn't go out and work for. You can't count the number of hours you work to get the equity build up. So what is it? It's a gift from God. It's a gift from God so you can use it to help you in your declining years. Okay, in your retirement years. Those are gifts from God. And by the way, it's not so much that it isn't repatriated very quickly to your property, and you never run out of equity in your property anyway. So is it a large dollar amount? Yeah, but those dollars aren't dollars that you can peg to hours that you worked. Those are gifts from God, in my opinion. Okay, all right, next up, the bank can take it away from me. Well, yeah, they can if you don't pay the taxes. But that's true today anyway. If you got a forward mortgage, the bank can take it away if you don't pay the taxes. Okay, so pay the taxes. Pay the taxes, pay the insurance, and keep up your house. Don't let the paint peel on the outside and all that kind of stuff. I don't know why FHA is like that, but if they see paint peeling on the outside, they demand that you fix it. So anyway, don't let the paint peel on the outside. If you have stairs where there's no handrail, put in a handrail, okay? Because FHA will come in and inspect your property and make sure that for safety reasons, it's all put together, okay? Or they won't give you a loan if there's something that they think is a safety issue. Okay. Well, sorry for the jump cut, but I heard some beeping and I thought the camera was dying or something. Anyway, the issue of the value falling below what is owed on the property. Yeah. Back in 2008, when it was private money, not an FHA product, but private money, it's true that the private lenders were kicking grandma out of the house if the value fell below what was owed. Okay, they did it. That's why it became an FHA product. Is no longer private money. So what happens? Let's say you have a $500,000 house, you owe $250,000 on it, and we have catastrophic thing in the marketplace where the value of the property goes down to $200,000. Well, there's $50,000 that you owe on the property that isn't there anymore in terms of the value, and that is when you get hit by a speeding bus. What happens to the kids? Well, the kids, your heirs, don't have to make up that $50,000. They can buy it or sell it at $200,000. That $50,000 evaporates into thin air, and it is not a taxable event on them. Some people thought that it was a debt relief and taxable at their then rate. Nope, it just evaporates into thin air. It is then fairy dust. So if it happens while you're in the property, nothing happens. If it happens after you leave the property, the kids can have it at the new value, or they can sell it at the new value, or whatever they can get for it, but it has to be at the new value. Okay. All right. So that's basically it. So what I want to tell you then is to be sure to look at my reverse mortgage 3-page scenario video, the reverse mortgage 3-page scenario video. That will show you an actual scenario that I will actually send you as an attachment to an email in a PDF format, and you can see exactly whether or not you qualify, and if you do, how much you can get and when you can get it. So take a look at that and you'll see. So thanks for listening to this one. I really appreciate it. This has been Reverse Mortgage Objections, and I'll wish you a good day. Thank you.